AM Best is proposing changes to two methodologies. The first relates to a section of Best credit rating methodology that focuses on insurance holding company and issued credit ratings. The second provides clarification on available capital and holding company analysis. Comments on the proposed changes are being sought from the insurance industry and other interested parties until March 31st, 2023. Joining us to provide more detail about these proposed changes are AM Best Senior Director Mahesh Mistry, Credit Rating Criteria Research and Analytics, and Mathilde Jakobsen, Director of Analytics. And Mahesh, let's start with you. Can you explain briefly the main proposed updates being made to the holding company analysis section of BCRM?
Sure, John. There are a few important points I'd like to highlight in relation to Best credit rating methodology. Firstly, the core components of BCRM are unchanged. That's balance sheet strength, operating performance, business profile, enterprise risk management, and lift and drag. Secondly, under Section 4, we are proposing revisions to allow narrower notching between the operating entity and the non-operating holding company. There are no changes to the treatment of debt. And lastly, we are introducing regulation in criteria. So, to explain this a bit further, insurance groups can be diverse and complex, so having an understanding of the regulatory environment alongside the company's capital management approach is very important. Regulation can influence how groups are structured, and this can have consequences for financial flexibility and capital fungibility across the group. Determining the level of notching between the operating entity and the non-operating holdco is not simply a lookup exercise. There is no list of jurisdictions. There would need to be an in-depth discussion with the company and an understanding of any restrictions on the flow of capital. To assist this, we have developed two AM Best classifications of insurance groups: collective capital management groups and entity prioritized structures. Collective capital management groups is where narrower notching is applicable and refers to regulatory priority that focuses on group capital management and solvency. Such groups exhibit greater financial flexibility and capital fungibility across the group, with excess capital held at group level. In general, they have greater ability to meet their obligations. Some examples would be the large European and Canadian groups. On the other side, we have entity prioritized structures, which has regulatory priorities at operating entity level. It is harder for capital to be extracted from those subsidiaries, and there is less jurisdiction over the insurance holding company. Examples being companies based in the US, where we typically apply 3 notches.
So Mahesh, how do you see this for impacting credit ratings?
That's a very important question. The impact on our ratings will be very minimal. We would expect less than 5% of our ratings to be affected, including associated debt ratings.
Tilda, can you take us through some of the proposed changes to the available capital and insurance holding company analysis criteria, as it will now be known?
Yes, thank you, John. So we made a number of revisions to this criteria for the purposes of clarification and transparency, and to make sure that we are reflecting the latest capital structures and hybrid debt features that we see in the market. So we made changes on a number of topics, but there are 2 that I would like to highlight here. So the first of those is the clarifications we've made on the treatment of downstream debt in our best capital adequacy ratio, or the BCAR, which is our proprietary capital adequacy model. The criteria in question specifies the features that hybrid debt, such as subordinated debt or preferred shares, have to adhere to in order to be granted equity credit in BCAR, which would be subordination, permanence, and servicing in the form of the ability to defer interest. So in addition to that discussion, we had some very limited comments about the credit we can give for downstream debt, and these comments have been expanded in the new criteria. So the concept of giving credit for downstream debt has always been a feature of our analysis, in particular for US groups. And so the proposed changes are really a clearer explanation of when and why we give this credit for downstream debt. And we give this more clear explanation in terms with reference to regulation and by using the concepts of different insurance groups that Mahesh has already gone through. So with a bit of simplification, we can say that we give equity credit for downstream debt in BCAR without this debt having to adhere to the usual requirements for permanence and ability to defer interest. We do that for groups that operate under regulatory regimes that place sufficiently strong restrictions on the upstreaming of capital from insurance entities to their insurance holding companies where the debt is issued. Where those restrictions are sufficiently strong, that creates what we would call strong structural subordination. And that strong structural subordination justifies giving credit for things like senior debt in BCAR. The proposed changes explains this and also clarifies how we would treat debt-funded capital when we run BCARs for operating insurers and when we run BCARs for the consolidated group at the holding company level. The other proposed change that I wanted to say a little bit more about is the change we propose to credit for perpetual preferred shares. With these changes, we would increase the flexibility in the treatment of debts that have features that are aligned with those of common equity. So the proposed changes to criteria would allow for the possibility of treating such debt as capital rather than as debt. And so to avoid placing the caps on equity credit for debt that we normally have in both leverage and BCAR calculation. Not all preferred debt would qualify for this more generous treatment, and we would have to have a very careful analysis of the features of any debts that would be a candidate for this new treatment. I think in terms of what might qualify, if we look at something that is perpetual preferred shares with no call dates, other than through the conversion into common equity, and with no mandatory dividends or coupon payments. In those cases, the features are really very aligned to common equity and so justifying a more generous treatment. We proposed this change because we have noted a trend towards using preferred shares to capitalize some insurance companies, typically in startup situations where a new investor comes in after the initial startup phase. And the flexibility that these proposed changes would introduce to criteria would allow us to give equity credit and really reflect the features of this capital structure rather than focusing on the names of it.
Mathilde, do you anticipate the changes to the available capital and insurance holding company analysis resulting in changes to any published ratings?
We don't foresee that. We don't think that these changes will lead to changes in ratings. The changes are primarily clarification, better explanation of our existing analytical approach. For instance, to equity credit for debt, taking into account the regulatory regimes that different groups operating under. So given this focus, it's not the case that debt that used to be given credit now won't be given credit or the other way around. But hopefully this criteria change will give a better understanding to both external and internal users of criteria of the underlying rationale for our considerations around the treatment of debt in our assessment.
Mathilde and Mahesh, thank you so much for taking the time to speak with us today.
Thank you.
Thank you.
That was Mahesh Mistry, Senior Director, Credit Rating Criteria Research and Analytics, and Mathilde Jakobsen, Director of Analytics. For more information about the criteria, visit ambest.com. For AM Best TV, I'm John Weber.